This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 14th. Some highlights from today's show. Tariff fears subside, gold went the wrong way, and US 30 yields are sending a red flag. Good day traders and a happy Valentine's Day. Let's get stuck straight into it. Looking across the board into Europe, it's a relatively good start for the commodity space. We can see of course that bid continues on from yesterday, and at the same time we continue to see that little bit of a soft dollar theme that started of course yesterday when Trump revealed the tariff or the reciprocal tariffs to us. We'll get to that in a moment. Looking at the bond space, of course it's pretty much flat, and of course the European equities again back up at that record highs. Now let's get stuck in and talk about our first topic of today, and that's very much about what did Trump tell us yesterday in terms of the situation around the tariffs. Well, the first part that we need to sort of recognize is that it's very much going to be a slow implementation. It's going to be a country by country basis. It's going to be, we're going to assess whomever is tariffing us, and we are going to reciprocate with the same kind of tariffs. Now, looking into it, if you go through, I think the real key line stuck out right at the bottom here. I'm just going to highlight it. It really did stick out here, which was ideally this process will result in us working with our trade partners to lower their tariffs and their barriers instead of increasing our own. In other words, this is very much what we spoke about in yesterday's Daily Market Rundown, which is the intention of Trump here is not to create deglobalization, but in actual fact, more globalization, because if everyone lowers their tariffs, ultimately more trade will be done and everyone wins, and the result is actually lower inflation because everyone gets lower prices as a result. So I think that's the key takeaway, and I don't think the market missed this point. I think the market really did take off once that specific point was revealed, and I suspect that's going to be the key driver of the equity rally now for the next couple of sessions, and perhaps for the rest of this quarter. It is really a positive outcome in a sense that we're not going to get any significant tariffs anytime soon. The uncertainty or the degree of uncertainty has been lifted to a degree because we now understand what Trump is ultimately trying to do in terms of his playbook. Now, we do know that 1st of April is the first point at which we're going to actually start seeing implementation of the reciprocal tariffs. And what that means is every single country has now got an opportunity, a window of around 6 weeks to get to the negotiating table and discuss with the United States ultimately the gives. Okay, that's what it comes down to. And we saw that again with what happened with Modi. Modi said, look, we're happy to consider easing tariffs. We'll buy more of your product. All to ultimately get to the table, get ultimately Trump on side in terms of, we will give you more, we'll reduce that trade deficit. And this ultimately is the Trump playbook. It's very much throw the threat out there, get them to the negotiating table and get those concessions. Okay, net and net, very positive for the markets. Now, let's move on and talk about our next topic, because this is going to become quite topical and very much a narrative over the course of the next couple of weeks. And it's all about Germany. They head to the polls next week. And in terms of the outcome, look, we're not expecting a far-right win or a significant surprise ultimately. But what we do expect to see is ultimately the far right doing very, very well with the conservatives heading up the government. Now, that's not the market moving thing. What we do have to pay attention to, and where the tradable opportunity comes now, particularly for German bond traders, is ultimately what they do with regards to the debt brake. Okay, now for those of you who don't understand the debt brake, it's something that's written into the German constitution that they can only spend a certain amount of GDP, and this obviously, of course, if we look back in history, because of World War II and the inflationary impact, this has stuck around in their constitution for many, many years. So it's something that's sort of sacrosanct in terms of German politics. But what we've started to see over the course of the last 2 years, keep in mind Germany has been in a recession now for 2 years, what we started to see is more and more calls for, softening this debt brake and ultimately spending more. In other words, getting the government to recognize its role, which needs to start investing in the German economy because of some of the structural changes that have happened since the war in Ukraine began. Now, What I want to stress here, and this is the key, is that there is a lot of talk, there is a lot of expectation that there'll be some short-term reform when it comes to the debt brake. So there'll be a minor adjustment. Ultimately, currently the debt brake is currently set at 0.35% of output, and this restrains the government from spending beyond its means. Okay, now the thinking goes that ultimately that ceiling should rise to around 1%, but in reality the German economy needs a lot more than that, and not just the German economy, but the European economy needs a lot more fiscal spending. Okay, we've seen this, ever since Mario Draghi was the ECB president, now Lagarde. They keep stressing, look, the fiscal has a responsibility. They need to spend in order to bring forward future growth. Okay, now I think the key takeaway and what you want to pay attention to is ultimately, what does that reform look like? Does that reform get done or does it not get done, and to what degree it gets done? Because if we go beyond the 1%, which is what many market participants, including Christine Lagarde, are calling for, if we get more reform and ultimately the government could spend more money, it means more issuance, and that will ultimately put a little bit of an offer into bonds. It will put an offer into inflation expectations. We should see inflation expectations hotting up, a little bit of steepening in the German curve, and that is where the opportunity scope lies as we move into and beyond this election result. So we'll talk more about election results, of course, as we get into next week. Now, our next topic of today is quite topical. It's all about that shiny, precious metal, and it's the gold chart. Okay, I put out a sort of a message yesterday in the Discord channel about gold's actually gone the wrong way. And the sort of thinking was, look, don't sell gold today, but definitely sell gold tomorrow. In other words, on the 14th of February, look for that short side opportunity in gold. Now, why do I think gold's gone the wrong way? Well, we just have to take a look at the course of the week and the price action and how gold has been responding to different themes over the course of the week, and that ultimately will reveal why gold did actually, in fact, go the wrong way over the reciprocal tariffs yesterday. Okay, so to point that out to you, I've got a 15-minute chart of gold, and you can see if we go back to the start of the week, I'm just going to highlight this in the chart. This is where we started the week. Okay, so we had that little gap down. Gold rallied, of course, on the Sunday gap, and ultimately because if we think about equities rallied, ultimately because of the fears around the tariffs and the inflationary impact, particularly because we had those 25% tariffs on aluminium coming in immediate effect, gold staged that rally up to record highs. Okay, and not only did it stage a rally, we had a significantly volatile $80 range Monday into Tuesday. Okay, so really, really straight line bid up, a little bit more inflationary fears, and the market put that little bit of a hedge on. We then fast forward, of course, to Tuesday. The market seemed to have topped out there. It just went too far, too fast, got the positioning all wrong, and that positioning came very much unstuck over the course of Tuesday, and it continued into the inflation print. Okay, that was the key. That's very, very important to stress, is that the market offered itself into the inflation print well ahead of it, which was a key piece of technical price action telling us that the market was now, in fact, overbought there, and we were going to see a lot more two-way price action. Okay, the point is then we went into the CPI. The CPI came out hot. Again, another very big print in the CPI. We can see gold again started to latch on to those inflation expectations rising. But the result, if you go look at the bonds, go look at 10-year bonds, they retraced the entire move over the course of Wednesday, Thursday. In other words, the inflationary fears around that CPI print were washed away. Why? The market looked through it. The market thinks it's seasonal, right? But gold didn't look through it. Okay, why didn't gold look through it? Well, gold is acting as a hedge against these tariffs all week, and we can see that again when those tariffs were announced yesterday. Gold did that little bit of a bid up, and it held on to those hedges. Now, if we look where equity markets are, they are just shy of record high territory. If we look where bonds are, they're up on the week. They've retraced that entire inflation print. Therefore, right now, gold is sitting very much on borrow time. And in actual fact, I suspect we're going to get quite a decent washout trade this afternoon. Now, what are we looking for? Well, that's our favorite old double top pattern. Watch for a little bit of bid up above these 64s. I suspect that is very short-lived. And once ultimately we trade in and around that 64s to 68 areas, I suspect we come down. Not only do we come down, but I think we'll very quickly make our way back down towards that 29.44 VPOC. I don't think we stop there either. I think very much the first little bit of support perhaps comes in around that 29.35. However, this is going to be probably a Monday, Tuesday trade next week. We should trade our way all the way back down towards that 2900 level. Okay, really, really good trade setup. I mean, structurally, you're talking about $70 a downside. In terms of risk, you're not going to to be needing more than a $15 to $20 stop. So we are getting 3-to-1 risk reward. And like I said, very much gold has gone the wrong way after the reciprocal tariff announcement yesterday. Okay, now turning our attention to 30-year bonds. This is a fantastic chart, gorgeous chart, and it's one of those charts you don't worry about. It's not signaling anything, but it is one of those things that we'll look at some point in the next couple of days, weeks, months, and we'll go, it was so obvious. Okay, the point is if you go draw up a 200-day moving average, okay, this is where moving averages become quite nice. Think of the 200-day moving average as the annual change in price for yields on a 30-year basis. Okay, now because the US economy is very closely linked to long-dated yields, this is why we pay attention to it. And what you can see over the course of the years is a very, very straightforward trend line. Okay, we made lower highs all the way down over the course of the years, and of course, we then had COVID where 30-year yields plunged. But ever since then, we can see that we've had this sort of almost, I want to call it a record-breaking rate of change. Okay, we've not seen this sort of steepness ever. Okay, I mean, none of us, well, very few of us were born pre-1980, and we've just not seen this degree of rate of change in bond yields. Okay, now remember, at the end of the day, bond yields is the rate of borrowing. And that rate of borrowing, so long as it's slowly moving, okay, it can be managed and consumed by the economy. But when it moves at this sort of rate and stays stuck here, at some point things start to blow up. Okay, and I suspect things are blowing up. Corporates are going insolvent, individuals are losing their homes, but it's still very managed at this point in time, and it's very much under the carpet. But the reality is that the longer we sit up here at 4.46, 4.5% 30-year yields, at some point, more and more things break, and then it escalates. Okay, the point is that longer-term yields up here for a long period of time will ultimately tip the US economy and the global economy into some form of recession. Okay, unless, of course, caveat, unless, of course, we do get a significant productivity boost from the likes, of course, of AI. But in that case, if AI is going to be deflationary, we should see yields lower anyways. Okay. Now, what I want to stress from this is I want to go look back a little bit of history and go and actually just point your attention to some of the points in history where we did have some elevated yield rates of change. Okay, because what you'll come to see is that typically speaking, high yields in its own doesn't ultimately cause the problem. Okay, what typically causes the problem is that we have high yields, or we have yields at an elevated level. Okay, I want to stress the example of 2006 and 7. We had that little bit of a regressive rally. We sat there for a long period of time, and the economies were fine. Okay, you can see the stock market rallied quite significantly in that high yield environment. But it's at some point that that high yield tips the economy into a recession. In other words, we start to see a growth scare, and the growth scare is ultimately what creates the correction in the stock market. Okay, and that's very, very important to stress. Bonds lead to the growth scare creates the correction in the market. Okay, and I think that applies so much to today because right now the US economy is thriving. It's growing at 2.5%. However, at some point, 4.5% yields are going to create a growth slowdown. And it's when that growth slowdown comes, that's when this bull run ends. Okay, now, yes, a lot of things can keep driving this growth cycle, and that's why we have to pay attention to the growth cycle and not so much the yields. Okay, the yields tell us that there will be a problem for growth at some point in the future, but it's ultimately that growth and those metrics that drive growth that are going to tell us when we want to be short for the corrective type measure. Okay. And then just for some fun, this is a bit of chart porn, but if we look at, since October, we can see that the S&P is almost up 70%, and yet we can see at the same time yields have, gone from 150 to 450 in a relative straight line. So again, all of this looks wrong at a macro level. It is wrong, and at some point it will prove itself and correct itself. But like I said, we need to wait for that growth scare. Okay, and then finally, let's talk a little bit about the S&P because it's a fantastic chart. We have now broken out. It's official. We are now breaking out. We are just shy of that record high territory, and we're about 1% or 0.5%, away from that record territory. Nasdaq got a little bit closer to that yesterday. VIX is sitting all the way down on the lower region of 16. I suspect that goes lower now. I think the clear risk event is out of the way, and I suspect now the markets are going to stage quite a nice momentum breakout to the upside. Keep a close eye. I mean, in terms of levels, it is one I suspect you're going to have to be quite aggressive on the bid. I don't think you're going to be allowed to just sit there and wait for a deep pullback. So I think the weekly high comes in at 61.25, good area. We should not be seeing this market back below 6100. So you can see 25 handles a downside. That is your stop ultimately. And I suspect we do just break up above the yearly highs and into record territory at some point over the course of today. So let's then finish off with one final chart, and this is again one of those nice sort of pawn charts, and it's pretty much a rebasing index with the DAX as well as the S&P. And obviously DAX is very topical. It has had a very good year. It is up 13.5%. Why? Number of things. I think DAX was cheap relative to the US, and we can see that confirmed that when we started to see the AI concerns around DeepSeek and the Mag 7 underperforming, that's ultimately when we started to see a significant divergence between the DAX and the US indices in the blue. Also, we do of course have this sort of truce going on in terms of potential between Ukraine and Russia that will just be positive in general for investment back into Germany and Europe in general. And then of course we do just have the case that we've seen a lot of money flow into the US, which does make it, in terms of diversification risk, a little bit more risky. Okay, so perhaps people are looking and saying, look, we want to move out of the US, move back into Germany. It's cheap. It'll also act as a little bit of a diversification against the current set of risks. And then of course, don't forget, the ECB is cutting rates, and that's always going to be more pro-positive for growth and of course the German economy in general. Okay, but the key takeaway: Germany's strong. Okay, the fact that Germany is now at record highs and again making another record high today, and the fact that the key risk event is now cleared in the form of tariffs, I suspect we'll start to see this divergence close up a little bit. So what I will be looking for over the course of next week is every day I come in that Germany is outperforming again or new record highs, I suspect the US equities are going to follow suit in the US session. Okay, that's then a wrap for today. In terms of today, it's now Friday, so of course keep your news feeds open over the weekend. We may get some news flow. But I think by and large now the tariff narrative is set in stone. We're not going to get too much more in the way of that, and we will need to now wait for the next sort of set of narratives to develop. Otherwise, if there are any other questions, of course, do post them in the Discord channels. And then finally, it's a Friday. Good luck out there. Always manage your risk, and of course, go make some money.